Hello. In this video, I'll be talking about operating leases. A lease is a contractual arrangement between a lessor, that's the owner of an asset, who leases a right to use an asset to a lessee, who is the user of the asset. And in return, the lessee makes periodic cash payments to the lessor. There are different kinds of leases, and there are various videos discussing those leases, but in this video, we're going to be specifically talking about an operating lease. And the way a company has an operating lease is if it doesn't meet the criteria for a finance lease, then it automatically is an operating lease. There is a different video showing the 5 criteria that would make up a finance or sales type lease if you want to watch that. So in an operating lease, it's more like a true rental agreement versus a finance sales type is more like treated more like a sale of an asset. An operating lease is true rental of an asset from the lessor to the lessee. And because of that, the lessor, who's the owner of the asset, they retain the risks and benefits of the ownership, and they do not record a lease receivable, and therefore they do not de-recognize the leased asset. In a sales type lease, the lessor would take the asset off of its books and record a lease receivable in exchange because it's treated more like a sale. Here in an operating lease, it's not a sale, so the lessor does not remove it from its books and does not have a lease receivable. Instead, the lessor, for the cash payment they receive every month or quarterly or year, whatever the lease agreement, the terms of the lease agreement are, they report lease revenue of an equal amount each period on their income statement. The lessee, who's the user of the asset, is essentially paying for the right to use that particular asset temporarily. They still therefore they still record an asset on their books, a right of use asset as a balance on their balance sheet, and they record a lease liability on their balance sheet as well, as you would in a finance lease, and they're calculated in the exact same way as you would for a finance lease. The lessee also reports an equal amount of lease expense on their income statement for each payment period. Let's go through an example. On January 1, 2027, Sans Serif Publishers leased printing equipment from Lease Corp. First Lease Corp purchased the equipment from CompuDeck Corporation at a cost of $479,000. Sans Serif borrowing rate for similar transactions is 10%, and the lease agreement specifies 4 annual payments of $100,000 each, beginning January 1, 2027, and at each year, December 31, 2027 through 2029. And the useful life of the equipment is estimated to be 6 years. So normally, to decide if this is an operating lease, you would go through the 5 criteria of what makes a finance lease, and if they meet one of those criteria, it's automatically a finance lease. But I'm just gonna, if you go back and look at videos about the finance and sales type lease, this is the part that's different here for an operating lease, that the lease term is for 4 years versus the useful life of the equipment is 6 years, and so that's 66%. But to meet the criteria of a finance lease, the lease term has to be at least 75% or greater of the equipment useful life. So we don't meet that criteria here, and therefore we have an operating lease. The price Sans Serif pays for the right to control the use of the equipment is the present value of the lease payments. So we have $100,000 lease payments, and we use the present value table of an annuity due with the number of periods equals 4 and interest equals 10%, and our present value factor is 3.48685. If you're not familiar with how we came up with that number, please go see prior videos about present value calculations. So the 100,000 times the present value factor The cost for the lessee is $340,685. And just the same, just like in a finance, and yes, in a finance lease, the lessee right here, records the same entry upon the commencement of the lease. They're going to debit the right of use asset, which is the present value of the lease payments, and credit lease payable, which is also the present value of the lease payments. And the reason that they debit the right of the use asset is because for that lease term, they have that right. And so they're going to capitalize that asset. So the lessor does nothing. There's no entry to take the asset off their books or to record a lease receivable. So this is very different than a sales type lease from the lessor's perspective. Now, in the problem, the lease started on January 1, so which is what we recorded our right of use asset for the lessee. But there's also the first payment that was made for $100,000 on that same day. The lessee will debit their lease payable, their lease liability, for $100,000 and credit cash for that payment for $100,000. The lessor will debit cash because they received the cash for $100,000. And now look at this account that they're going to credit. It's deferred lease revenue. This is a deferred liability account. It's basically it's because the lessor got the cash in advance, and there's a whole video about that, about deferred unearned revenue or deferred revenue in the prior chapter, but they haven't earned that revenue yet. They've received the money, but have not yet provided the use of that equipment for the year because they received that money on January 1, 2027. And so they're going to credit this liability for deferred lease revenue for $100,000. Okay, let's continue on with the journal entries for the lessee, and then I'll flip it to the journal entries for the lessor for January. We just did January 1, but then we'll do December 31 as well. Okay, so this is just a repeat of the prior slide where the lessee records the initial transaction of the lease. They debited the right of use asset for $348 and credited lease payable for $348. And I'm going to focus on this first account, this right of use asset. And the first step when you have an operating lease is you're going to amortize this right of use asset. Okay, and you do that in a finance lease as well, but the calculation is different here. What we need in order to do the right of use asset journal entry, we need to have a lease amortization schedule. By now, you should be very familiar with how to calculate these lease amortization schedules. We saw the same schedules with bond payables. The concept is exactly the same. So here, I want to just point out, and this will come into play in a couple of minutes, that this last column on the right is going to give you the outstanding balance of the lease payable or the lease liability, not necessarily the outstanding balance of the return on asset. Okay, so just keep that in mind. So for this example, on January 1, 2027, we recorded a lease liability of $348,685,000. Also on January 1, we made a payment for $100,000, right? We credited the cash for $100 and debited lease liability. So therefore, our entire lease liability is going to go down by that $100,000. On 12/31/27, again, we're making our second payment of $100,000, and we need to figure out the interest component versus the amortization expense component of this asset. And for this lease, we're going to take our effective interest rate that we're given of 10% multiplied by the beginning carrying value, which at 12/31, the beginning carrying value of the lease liability is $248,685. So 10% of that is $24,869. And this is effectively going to be our interest expense that we are going to record. Okay. So when I take the difference between my payment and this interest, I have a decrease in my balance for the return on asset and the lease liability for $75,131. What I'm going to do is I'm going to debit amortization expense for $75,131, which was just my payment less the interest component of it. And I'm going to credit my right of use asset. So here's the breakout between the interest expense and amortization expense. I want to point out that the lease expense is $100,000. In an operating lease, when you look at your income statement, they're going to report this lease expense as one number. They do not break it out between interest and amortization like they do in a finance lease. However, for purposes of recording our entries to know what amount we're going to credit our right of use asset and what amount we're going to debit our lease liability, we still need these pieces of information. So for purposes of this video and in your textbook and in your homework, when they ask for journal entries, you're going to break out the interest expense and amortization expense components, but just know that in real life, that's not what happens in an operating lease. It just all gets booked to one account called lease expense. Okay, so now we have addressed how we amortize down the right of use asset account that we booked on January 1. Now let's focus on how we write off the lease payable account. The way we do that, so this is right here, I'm going to split the screen. This is the first entry we just did a couple slides ago. And now I'm going to credit, my second entry is going to be, I'm going to credit my cash for my lease payment, which is $100,000. I'm going to debit my interest expense, right, which, let's just go right here, is the 24,869. So I'm going to debit here my interest expense 24,869, and then the debit to the lease payable is the difference of 75,131. Now let's look at the lessor side. Okay, so the lessor, when we first commenced the lease, we didn't record anything, but we did receive a cash payment and we debited cash and credited deferred revenue on January 1. Fast forward to December 31, the lessor has now earned that $100,000 because they've provided that asset to the lessee for the year. So they're going to have multiple journal entries recorded. The first one that we're going to go through is that they've earned this revenue, that they booked a deferred lease revenue liability on January 1. So we're going to debit the deferred lease revenue from the January 1 lease payment for $100,000, and now we're actually going to recognize that revenue on our income statement. So we're going to credit lease revenue for $100,000. Now the second entry is on 12/31, they get another payment, right? That's their second lease payment that they received. So again, and so that they received that on 12/31/2027, and that payment is to lease the asset for the entire following year, for all of 2028. So we're going to debit the cash for $100,000, and again, we're going to record a liability for the deferred lease revenue, right? A deferred lease revenue liability. And then our third entry that we'll do on December 31 is, since the lessor still owns that asset and has not removed it from their books, they need to depreciate it just like they do all their other assets. In the problem, we're told that the cost for the lessor, they purchased this asset for $479,079, and that the useful life of the asset is 6 years. I want you to notice that so that's what we're going to use our depreciation. We're going to just do a straight line depreciation, taking the cost divided by the useful life, which gives us $79,847 of depreciation expense for each year for the next 6 years, and then we're going to credit the accumulated depreciation for the same amount. So the depreciation, we're going to divide that, the straight line depreciation, the number of years is the useful life of the asset, because the lessor owns the asset, and even when the lease is complete, then the lessor still has that asset and can still use it. So you do not use the lease term number to depreciate that asset. You use the useful life term, the useful life amount. So just to reiterate, the entries for the lessee, okay, will have an interest expense component and amortization expense component. However, it should be recorded in a single lease expense item on the income statement, but just for these purposes in the homework and the text, we're not doing that. Versus in a finance lease, the lessee will report the interest expense and amortization expense separately in the income statement. The lessor on an operating lease has only a single lease revenue account that they report, and it's the same amount each year. This slide, I'm not going to go through, but this slide just goes through all of the journal entries from the commencement of the lease till the end of the lease for the lessee side and the lessor side, and gives you all the debits and credits for the entire term so you can follow it. I'm not going to go through it step by step because that's just way too much for a video. But my recommendation, if you really want to visualize how all of these entries work together, is to put them into T counts, because to me that's the easiest way to visualize, but you can do it however which way is best for you. So this next slide is the December 31, the 2029, and the conclusion of the lease at the end of the year. So at the end of lease term, I should. Let's go through this one other example, and for this one, I'll be going through the journal entries, but putting them into T accounts. On January 1, 2027, Super Sports Supply recorded a right-of-use asset of $135,180 in an operating lease, as an operating lease. The lease calls for 10 annual payments of $20,000, and at the beginning of each year, and the interest rate charged by the lessor was 10%, and the balance in the right-of-use asset and the lease liability at 12/31 is what? Okay, so let's just start, and I'd like to first, let's see, how am I going to do this? First, I'm going to put my right-of-use, I'm going to do my T account. Here's my right-of-use asset right there, and no, actually, I'm going to do over here. I'm going to do everything over here. So let's just start with actually the amortization table. I'm going to have my date, my cash payment, my interest component, my interest expense. And this is really only applicable to the lessee side, because when we have an operating lease, the lessor just records the lease revenue and unearned deferred revenue each time they get the payment. So assuming they get in advance. And this is my decrease in balance here. And this is my carrying value for the lease liability. The lease liability. And it tells us that we start at 1/1/27, and that the balance in this, for this lease, the present value of the lease payments is $135,180. The first, so here's what I'm going to do. I'm going to have my T account here for my return on use asset, and my T account here for my lease liability. To record this initial lease, what we what we would have recorded is we would have debited return on use $135,180 and credited the lease liability for 135, 180. Okay, that barely fits. So let's just put those into our T count. So on 1/1/27, I have 135, 180. And on my lease liability, I credited 135, 180 on 1/1/27. Now on 1/1/27, they made their first payment, which was $20,000. So the first payment on 1/1/27, there is no interest component to that payment, and it just reduces our lease liability account by $20,000. So on 1/1/27, we debited. I'm going to go now for. I'm still getting this green. We debited the lease liability by $20,000 and credited cash. We made that payment right away. So on 1/1/27, I'm going to show a debit here for the $20,000 on 1/1/27. Now we're going to go to 12/30. Oh, so now my balance in my lease liability on 1/1/27 is $115,180. So I'm going to put that on my chart here, $115,180. Okay, now I'm going to go 12/31 because the problem asks us what is the balance of the return on use asset and the lease liability on 12/31. So 12/31, we made another $20,000 payment, but now there is an interest component to that payment, right? And that interest component is going to be using our beginning carrying value amount of the liability, which is because that's what you pay interest on. You pay interest on the liability, which is $115,180. And we're told that our interest rate is 10%. So that's equals to $11,518. So our interest here is $11,518, which means that our decrease in our return on asset and lease liability is the difference, and that number is $8,482. So now I'm going to put these, let's record these two entries, and then we'll put them into our T accounts. Let me just go up a little bit. Let's see if I can, okay, this is okay. So my first entry that I'm going to record is going to be on 12/31. On 12/31, I'm going to have a debit to my amortization expense for the $8,482, and I'm going to credit my return on use asset for $84.82. So let me put this credit right here. This let's call it A right here. A. I'm going to go green again. I'm going to credit my return on asset $84.82 on 12/31, and so then my 12/31 balance for my return on use asset is going to be $126,698. That's going to be my 12/31/2027 balance. Okay, so that answers one part of the question. Now the other part of the question is, what was the lease liability balance on 12/31/27? Well, we're going to do our second entry of 12/31, and that's to record our interest expense component, which is a debit to interest expense, and we are told it is $11,518. So we're going to debit interest $11,518. We know we made a cash payment for $20,000, right? So I'm going to credit $20,000. And then the lease liability, we're going to debit the lease liability because now we've reduced a portion of that liability, and that debit is $8,482. So now when I go back up to my lease liability T account, and I'm going to extend it right here, I have another debit on 12/31. I have a debit for $84.82, And then my new balance for my, oh, you know what I did? Oops, I put this on the wrong side. Here, my 1 balance, that 115, 180 should have been on the credit side. I'm so sorry about that. But on 12/31, I'm debiting $8,482. And so my new balance for my lease liability on 12/31 is going to be the 115,000 less 84.82, and that's going to give me $106,698. So those are just some things to if you get a problem in the book or on an exam, there's could be several different questions that could be asked here.